I'd like to call up on stage, up to the podium, Dr. Indrajit Coomaraswamy, Governor of the Central Bank of Sri Lanka, to share his expert views on the macro prospects for the country. Please come up on stage, sir.
Good morning, ladies and gentlemen. Let me first thank the Colombo Stock Exchange, the SEC, and the Singapore Sri Lanka Business Association for organizing this investor forum, and also for inviting me and giving me the opportunity to share some thoughts with you this morning. I must tell you that I'm struggling with a frog in my throat, so please bear with me. The Prime Minister laid out very lucidly and with great clarity the government's vision for the development of the country and some of the key policies and programs that are being put in place to give that vision material existence. What I'm going to do is really to focus on the progress that's being made towards stabilizing the economy. As you know, central banks are preoccupied with stability. So that's going to be the main thrust of my remarks. But I also would like to convey some messages regarding the nexus between this increased stabilization that we're seeing and the framework that is being created for a higher growth trajectory for the economy. On stability, I think the headline message that needs to be given is that there is cause for measured and cautious optimism. It's not a euphoria moment. There's certainly no cause for complacency, but I would like to put before you certain facts which will substantiate the position that I'm taking, that the economy is actually stabilizing quite nicely. That the policies that have been put in place over the last 18, 20 months, particularly after the government got the support of the IMF for an extended fund facility, that the policies that have been put in place are actually now beginning to bear fruit. Why do I say that? If one looks at the key indicators of stability in an economy, let's take inflation first. Headline inflation in February was 4.5%, well within our target range of 4 to 6%. Core inflation was 3.5%. Now, core inflation now for several quarters has been within the 4 to 6% target range that the central bank has set. However, we had a peak in headline inflation. Headline inflation includes volatile prices over which monetary policy has very limited influence. For instance, food prices, fuel prices, etc. Now, because of the supply disruption caused by the fact that 3 consecutive cultivation seasons in Sri Lanka were affected by drought, resulted in this spike in food price inflation in the fourth quarter of last year. Food price inflation actually spiked at about 14%, which meant that the headline inflation was dragged up to close to 8%. But now the supply situation has increased. The harvest is coming in for the next season, plus the government has brought in some imported supplies, which has meant that we are now seeing food price inflation abating and headline inflation moving towards the core inflation rate. And as I said, it's now 4.5% for headline inflation in February, 3.5% for core inflation. Core inflation has been throughout within the target. So the monetary policy stance of the central bank, which has been which has had a tight bias over the last 18 months, has now borne fruit. And I hope after this blip in terms of the supply disrupted peak in headline inflation, we can go back to a period of sustained inflationary outcomes which will be within the target. As the central bank sees it now, throughout the course of 2018, inflation will remain within the 4 to 6% target. So that's in terms of the domestic indicator of stability. If one looks at the external account and whether there is increasing stability on that front, The overall balance of payments in 2017 had a surplus of $2 billion US dollars, which meant that the external reserves of the country, the gross external reserves, which amounted to $6 billion US dollars at the end of 2016, increased to almost $8 billion, $7.9 billion at the end of 2017. Not only was there a build-up in the volume of external reserves, which are currently giving us about 4.5 months of import cover, not only was there this build-up in the volume, but there was a qualitative improvement, because at the same time as there was this increase in gross reserves, we were able to bring down short-term liabilities. Swap agreements, which amounted to $2.5 billion US dollars at the beginning of 2017, have now come down to $1.5 billion. So we've been able to bring down short-term liabilities by $1 billion and increase the total volume of reserves by $2 billion as well. So improvement in quality and quantity of reserves, side by side with the improvement in the inflationary environment, has meant that the economy has shown signs of stability. Now, stability alone is not enough, and it certainly doesn't win elections. So we need to see how one can translate this stable environment into a higher growth trajectory. So what has been happening there? There are some positive signs there as well. Clearly, as a country with 21 million people, with per capita income of about 4,000 USD, external demand has to be a key driver of our growth process. We cannot depend purely on domestic demand. We tended to do that for a few years, and that has cost us dearly. But we've now changed policies, and we are much more oriented towards an export and FDI driven growth strategy. And on those fronts, there are positive developments. Again, no cause for euphoria, but positive developments. Sri Lanka's exports in 2017 were at a record level, the exports of goods and services. Sri Lanka's FDI attraction was at a record level in 2017. Records from a very low base, I must tell you. Our performance in terms of exports and FDI has been really quite poor, more than poor, appalling, really, in recent years. But we're seeing a turnaround. We're seeing a turnaround, so a record in exports, a record in FDI, a record in flows into the stock exchange. So again, from low bases, but direction of travel is positive and a cause for optimism. So all this means that we need to press on with what we've been doing. And there it was encouraging to hear the Prime Minister being very determined about how the government is going to continue to implement the policies that it has embarked upon. One other thing I should say also, while the trends in FDI and FII into the stock exchange are positive, another positive indicator was that the central bank runs a business outlook survey. And for the first time in a number of quarters, that moved into positive territory for 1Q 2018. So even the domestic sentiment is beginning to improve. All this taken together clearly means that we are on the cusp of possibly moving to a higher trajectory of growth and development in the country. But we need to sustain what we've been doing, and we need to build on it. So if I may go back to the stabilization theme, what is being done to consolidate the gains that have been made as far as stabilization is concerned and to build on it? And here, the government is putting in place 4 clear frameworks for macroeconomic management. As the Prime Minister pointed out, the government has embarked upon an aggressive revenue enhancement-based fiscal consolidation strategy. And we are now beginning to see the results. For the first time since 1953, there was a surplus, a primary surplus in the government's budget last year. For the first time since 1987, we expect a current account surplus in the budget. So these are structural problems that have been there in the government's fiscal operations for many, many years. And the main source of instability in the system for decades in Sri Lanka has been the government's fiscal operations. Sri Lanka has been a classic stop-go economy, with fiscal operations driving excess demand in the system, leading to balance of payments problems, leading to higher inflation, then the brakes being slammed on, and then you have another cycle of government fiscal excess and another period of stabilization. This has been a repeating cycle. And the structural problems in relation to the primary surplus, the structural problem in relation to the current account deficit were never really tackled effectively. So for the first time now, for many decades, we are beginning to see progress as far as the government's fiscal operations are concerned, and that has to be sustained. If it is not, then all bets are off. We go back to our repeating cycle of instability. But if the government is able to persist with the progress it has made so far in terms of fiscal consolidation, we then enter a new era for the Sri Lankan economy in terms of strong macroeconomic fundamentals. So that's on the fiscal side, and the government has made some brave decisions. It increased the VAT rate from 11 to 15%. It took away some sensitive exemptions, and the results are already showing in terms of the government's revenue performance. The Prime Minister cited some numbers. And also the new Inland Revenue Act, which kicks in April, and the measures which are being taken to improve tax administration should all mean that the progress that has already been made in terms of fiscal consolidation should be maintained. So that's fiscal policy and the framework. One other thing. Not only is this revenue enhancements-based fiscal consolidation moving in the correct direction, but from the central bank's perspective, we are encouraging the government to give teeth to the Fiscal Responsibility Management Act. Sri Lanka has a Fiscal Responsibility Management Act which sets targets for the overall budget deficit and for debt to GDP. However, the act lacks teeth, and in most years, those targets have been breached. So we are encouraging the government to give teeth to those targets so that there would be very specific reasons when the target can be breached. It could be a natural disaster, it could be an exogenous shock which requires aggressive counter-cyclical fiscal policy to overcome a recession in the economy. So there could be these specific reasons when the target can be breached. But otherwise, these targets would be binding, and when the target is breached, the government would be required to set out how it would move towards bringing the outcomes within target over a period of time. So these are the kind of fiscal rules we are encouraging the government to adopt to really institutionalize the improvements that we're seeing on the fiscal front. Monetary policy. The central bank is in the midst of introducing a flexible inflation targeting regime. We've already made significant progress in strengthening the capacity of the central bank for modeling and forecasting, and we are also in the process of amending the Monetary Law Act so that there is a strong legal and accountability framework to support the flexible inflation targeting regime. And for flexible inflation targeting to work well, you need good fiscal monetary coordination, you need central bank autonomy to run monetary policy. So these will all be embedded in the new Monetary Law Act, and there will be an accountability framework as well. In some countries, the central bank governor has to resign if you don't meet the target. So that's probably a good discipline to have. My colleagues haven't shown me the accountability framework. Perhaps they have this in mind for us as well. But anyway, the idea is to move to a much more data-driven, forward-looking monetary policy than we've had in the past. In the past, we have tended to do too little, too late. We need to be ahead of the curve, and the Monetary Board is very keen that it should be ahead of the curve going forward. On the exchange rate, historically, we've tended to have a kind of a dirty float where we've tried to defend a fixed rate using scarce, often borrowed reserves. We've moved away from that. The policy is not to use reserves to defend a fixed rate. Clearly, if there is volatility and speculation. We would need to smooth things out. Otherwise, there's going to be a much more market-oriented exchange rate policy. And we're also the IMF, who are giving us some very important technical assistance to develop the FX market, to have some rules, some parameters within which we will manage the foreign exchange market. So again, the idea is really to have clarity, and have a much more rules-based approach to macroeconomic policy making, and to have transparency in what we are trying to do, so that there will be greater consistency and continuity in macroeconomic policy making. The fourth framework in relation to macroeconomic policy making that I would like to talk to you about relates to liability management. It's no secret that Sri Lanka's debt dynamics makes us an outlier in terms, if you compare us with our rating peers, our debt to GDP ratio is very high, and we're very conscious of that. Sri Lanka has never ever missed a single payment as far as its debt obligations are concerned, and we certainly do not intend to start now. So we have put a great deal of effort into trying to understand the debt dynamics, and we have got a plan which we think can manage both the domestic and external debt repayments. What are we doing to create the framework for that? Now, at the moment, there is a borrowing limit in any given year for the government, which is limited to the financing requirement for the budget. So the government's borrowing requirement for the year puts a cap on the amount of borrowing that one can undertake. Now, that means that you cannot borrow extra money to build buffers for liability management going ahead. What the new liability management bill, which is in Parliament right now, which I hope will be enacted in a matter of weeks, will do is to give us the flexibility to borrow above the government's annual borrowing requirement. Again, there will be a limit, and not only a limit, but also specific reasons for which this additional borrowing can take place. But that will give us the capacity to build buffers. We have already built a bit of a buffer to manage the domestic debt repayments, which are peaking this year. And we will be building buffers to do some liability management to address the bunching of external payments that we see ahead of us between 2019 and 2022. So again, we are creating this framework which we hope will enable us to be very proactive in the way we manage our commitments in terms of both domestic and external debt. And while it is challenging, I think I don't mean to underestimate the problem. It is a challenging problem. Sri Lanka's debt dynamics are very challenging. However, we feel we have a plan to deal with it. So, to sum up in terms of macroeconomic stabilization is concerned, if you look at the key indicators in terms of inflation, in terms of the external account, things are going in the right direction, and we feel we are putting in place frameworks which will institutionalize the improvements that have been made and also make those improvements more durable and resilient. Now, on the growth front, growth in 2017 is going to come out a little under 4%. There is an output gap. The central bank thinks that the potential growth rate for the economy is 5.75%. So we need to push growth up. Now, the conditions are being created through greater macro stability and better fundamentals. And as I said, we're beginning to see the results in terms of the domestic business outlook survey, in terms of FDI. So going forward, provided the government is able to sustain the reforms it is introducing in terms of the investment climate, there's a lot of work being done to improve on some of the pillars of the World Bank's Ease of Doing Business Index. There is work being done to focus the investment promotion work of the BOI with the help of the Center for International Development from Harvard. There is work being done on the trade facilitation side, whereby there is a single electronic window being introduced into the customs, a trade portal, and generally trying to clean up things to reduce transaction costs for goods moving across borders. An important thing, again, is on the trade policy side. I'll come to what the Prime Minister said about the trade agreements, but a couple of very important steps that the government is taking. the anti-dumping bill, the trade adjustment package for domestic industry, but the government is committed to reducing and eventually eliminating para-tariffs. Sri Lanka has not been able to play in the supply chains, the Asian supply chains, which have been the most dynamic component of the international trading system. Only about 7% of our exports are part of cross-border production sharing networks. Even India, which is still a relatively closed economy, has 22% of its exports as part of global production sharing networks. One of the main reasons why we have not been able to do that are these para-tariffs. Because in modern production sharing networks, the line between imports and exports gets blurred. You need to bring stuff in, do your little bit in the chain, and then send it out. If you stick para-tariffs in the middle of it, you don't get to play. And that's what we did. So now we're beginning to remove those para-tariffs, which will enable us to become part of these cross-border production sharing networks. And given what you've heard about our strategic location from the Prime Minister and our colleague from Port City, given our location, really there is tremendous potential in terms of plugging into cross-border production sharing networks. On the trade policy side, as the Prime Minister says, if we're able to add to the Singapore agreement by deepening and widening the Indian agreement and also having this comprehensive agreement with China, and I can say, he said we may be one of the countries, actually we would be the only country in the world which has preferential access to China, India and Europe through the GSP+. No other country in the world has access to all three of those markets. So you can locate in Sri Lanka and sell on a preferential basis to each of those markets. That, combined with our location, clearly is something which we can leverage to our advantage. So what is the story at the end? It's a moment of promise. And I know all of you know what's been going on in terms of the politics of Sri Lanka. We need to, and it's very important to remember that these were local government elections, right? Not a national government election. There has been a cabinet reshuffle, but no key economic minister has been changed. So we can, and the Prime Minister was determined to go ahead in terms of continuity and consistency of policies, and that was very encouraging. So that's what we see. And you must understand in Sri Lanka, Sri Lankans would know this well, but those of you who are not from Sri Lanka, we have a very robust adversarial policy. It is untidy, it is messy, it can be counterproductive, but it has given us freedom for 70 years. We haven't had a single day's military rule in our country. In the 70 years since independence, we have had freedom. We have had social development. Sri Lanka, social development, it outperforms in terms of its social indicators. If you look at the gap between a country's ranking in terms of per capita income and its ranking in the UNDP Human Development Index, Sri Lanka has the second biggest gap. It is an outperformer as far as social development is concerned, and it is because of our very untidy and messy political system that we've been able to have this social development, because the system has to respond to the people. And we've also had a lot of social mobility, much more so than in many countries. So this messy and if you're a central banker, very irritating political system that we have does have its uses and has served us well. And we have this freedom which we cherish, and it is a crucial part of the Sri Lankan DNA. So you have to look through that. You have to look through that and see what is happening in terms of macro stabilization, in terms of structural reform, in terms of the opportunities being created, in terms of the location of the country and the integration that is taking place across the region, both to the east and the west. Thank you all very much. It's a good time to look at Sri Lanka.